Welcome back to a day in the life of the asset manager and an underwriter. And today you get to talk to the underwriter, which is me. So glad that all of you guys could be here today. The first thing that I want to talk to you a little bit about today and have more of a conversation than, it's speaking at you, right? Is as an underwriter, we as a company have kind of set benchmarks for what we look for. What is a good deal, right? Like what do we qualify as a good deal? What things do we need to see in order to be like, hey, we want to move forward with this? And some of those things are metric return based, right? So like we have said as a company, like a 20% ARR was the minimum that we'd be looking for. We've kind of moved the needle on that a little bit because the markets have shifted quite a bit. So we're looking at like 17% is a pretty solid deal in this market right now. We've also talked about cash on cash. So cash on cash can paint a little bit of a story, right? But in the end, if you're not hitting a 7% cash on cash and you plan on doing a 7% pref, you will never catch up and you will never be able to pay your investors. So if your cash on cash is under 7% and you are having a 7% pref, you should not do that deal. So like bare minimum cash on cash is 7. We probably need to be closer to 7.5, 8, right? And the newest metric that we've started to look at, one, because it's super complicated, and so we've kind of avoided it because there's a lot of other ways to be able to tell if a deal is good. But we've had a lot of conversations with, my other hat, take off my underwriter hat, put on my capital raising hat, and the family offices that we talk to and the different institutions, they look at IRR more than anything else because they want to see the speed of money. And we've gotten a lot of feedback about IRR of like, 13% is good, 15% is good, 17% is good. But it's really dependent upon who is looking at that number and what they want from that number. And so as we learn more about what we're looking for and adjusting our buy box, but not only adjusting our buy box for the year or for what we're doing, but adjusting our buy box for our market. What does the market hold? What does that look like? What is a good return in this economy today? So I'm just curious, and I want this to be a little bit of a discussion, last benchmark that we look for is it has to be cash flow positive day one. Unless there has to be some crazy circumstance where we accept something that's not cash flow positive day one. It has to be like, very distressed. We're getting it for a steal. It's probably a cash deal that we need like hard money, which would also break another one of our rules of we like very boring, predictable agency debt. That's pretty much it. So if we broke a lot of rules is why we would look at something with negative cash flow. But we love to see positive cash flow day one in our underwriting every single time because we want to know that this thing is going to produce always. So when you're underwriting, when you're looking at deals, whether you are an investor, an underwriter, wherever you are in your journey, what metrics do you look at that you're specifically like, this is a good deal, I want to move forward with it?
You looking for verbal
Yeah.
response?
I'm looking to have a conversation, David. Come on, man.
In other words, we're typically looking for high teens, and the IRR, double somebody's money in ballpark 5 years, hopefully less. But anyways, cash on cash, bare minimum 6, preferably close, 8 or more, and something where we can add value and yet still leave meat on the bone for the next guy. So if you need an exit plan of selling it as opposed to refinance and hold, then you can accomplish that. So those metrics have to line up. We are seeing, um, since there's 200 billion in debts that are really in trouble out there, where folks bought with variable debt, which is what got us in trouble in '08, 9, and 10. And if they did that, then Ken McElroy put out a note. That was one of the guys I follow, and he said, "You know what we're offering them? They were bringing us a 1,400 unit portfolio, 60% of the loan value. And so they're still looking, everybody's looking for bargains. So when we turn in an LOI, the broker comes back disappointed, my seller doesn't like me, doesn't like you. I'm thinking, you will like us in a year because we're ready to close in 21 days. So that's what we're looking for. But it really depends on the size of the deal, because if you get up above a certain amount, above a $10 million mark, we have sponsors that say, we'll sponsor you, but I need you to bring me something at least 15 million. We don't want to see anything really less. So it kind of depends on that. And then sometimes their metrics are even stronger than what I suggested. They're looking for better than that. But I've seen some guys that are so great at creative finance, and I've done a lot of creative finance in single family and duplex space. I have not yet done it. First offer I made on a multifamily, the guy had a 13 unit. He wanted $1.3 million for it. And I said, would it be okay if I bought your LLC, say 81%, 79% or something, and then I made you a loan for your equity of what you're trying to get out of it? And could that work? And then if you default on that loan, I have write-offs, and then we drop you down to 5%. But that way I can keep making the payments on your loan and own the LLC and phase you out of it. Would you consider that? Because he said he wanted a 1031 exchange. And I said, if this were a way to get you your cash where you don't have a tax liability, the IRS will walk away from that and say that's legit every time. They won't on a single family, but they will on multifamily. And he was of Chinese heritage, and he just didn't understand it. He wanted what he wanted. So he's still stuck with that property. And so what we try to do is just track and still reach out every quarter and say, hey, we're still interested. But that's the long answer to your short question. Sorry for the long answer.
No, you're good. I love it. Couple of things in there, right? Like I reach back out to my brokers on stuff that we've put an LOI on and we didn't win because I want to know if it closed. And sometimes they're really bad about reaching back out when a deal falls through. And there's been a couple of times where they're like, yeah, it fell through. And I'm like, cool. What's, tell me the story. What's going on? Is this still in play? Can we move forward with it? And sometimes they just pull it off market. And sometimes they're like, hey, you were, second best. So if you want to keep your LOI, like we can push forward with it. We've had that, but we were not in a good spot to be able to move forward at that point. But I was just curious. So yeah, follow up is huge, right? And I do think that this year we're going to see a lot more financially distressed units than we have seen in a long time because of the lending market that people jumped into and took the creative financing to a place where it probably shouldn't have been. And financially distressed is one of the best ways to be able to buy an apartment complex. It's buying stuff at discounts. 60% of loan value is crazy. So,
and I think the other complementary part of that is the supply cliff that we are going to experience from 27 to 30 or thereabouts. So, there's that fruit, we hope,
yeah.
that will also magnify returns.
Yeah, I know because right now we have an LOI put out there, and the deliveries coming in the next 3 years are 200 unit delivery for a MSA that's more than 1 million people, and it's like, okay, cool, that probably bodes well for us. So I have another question. And this is a genuine, curious question from me. So I'd love your guys' feedback on it. If you have an underwriting piece that you go through and you underwrite it all, and there's not much room to move the rents, they're pretty much, within $100 of being at market value. In our underwriting, we usually never put other income. In fact, most of the time we take out other income because we consider it bad other income, right? Like month to month or insufficient funds and things like that. So we take those out because we don't want to bank on them. But you get done with your underwriting and there's not a ton of wiggle room, but it still comes out to meet all of your metrics or potentially exceed them. And there's not like any big value add lever that you're pulling on this one. What do you do? What are your thoughts on something like that?
Well, I think one of the things is that expenses have gone up, every single one of them, and I would be going back over all those areas and making sure that I'm getting the best deal that I can on that, because that's something you do have some control over.
Yep.
Inflation is whatever inflation is, but anything that shows expenses going down, I don't believe that for a second, not one.
Yeah, there's the bucket that I call controllable expenses from your property management company, right? It's payroll, gen ad, marketing, turnover cost, R&M, contract services. Those are the six controllable from your PM. They should be able to move that needle in some way. And that's why it's so important to get a budget from a property management company when you're doing your underwriting, not before you have it under contract of like, hey, are my assumptions correct? Am I in the ballpark? Am I way under? You should always be way over, just FYI.
Yep.
But how would you feel about like would you move forward with that property?
Okay, with not much upside.
Well, you're still hitting all of your metrics, right?
Oh, okay, you are.
Yeah,
Okay.
like your underwriting says, hey, I'm hitting all these metrics. The
Oh,
only
okay.
lever that I'm pulling is maybe $100 increase in rent to bring it up to market, but there's no like traditional value add,
Yeah.
right? But there is some other income that you can always add in, but we don't add that to the underwriting, but you're still hitting your metrics. David?
Mhm.
Well, I can answer that. My first peak experience was last year. I met a lot of wonderful people there, one of whom I've partnered with, and we underwrite things together and we do life together. He's on the website and all of that. One of the people that I met at the cash flow portal table, and I was fascinated with the thing I liked about cash flow portal was, what did I not like? I liked everything about it, but you could give your customers, excuse me, investors, an app in their hand in their smartphone. If you need to see how your investment's doing with this property, it's on an app. You get your login, you can see it, each property, each investment, it's right there. Each property has an app. You get updates daily, minute by minute, if you want them, right there, right there, right there. So I met a guy there, and I said, how can I help you in your business? He said, I'm good, I'm good, I'm good. Said, but if you ever need a mentor, let me know. I said, well, I always could use a mentor. Tell me about it. Let's talk. And his name was Jonathan Way, WEI, of Greystone Capital Group in the Dallas area. You familiar with him?
Nope.
Well, at any rate, I said, what's involved? And he said, well, I've got a course you can take, but you can sit in on meetings, you can kind of learn how I do stuff. And I said, that sounds like a good thing. And it was affordable, so I did. One of the properties that he brought up last September, and we got it closed. The lender had a delay, so we got it closed. We actually were able to help him raise capital on it and actively sit in on the GP meetings and that sort of thing. It was one that exactly did what you're talking about. It was worth 4.5, 4.7 million, but he got it at 2 million and wanted to take reserves and stuff. So he got it at a half price. So it met all the metrics, even if you didn't do any, that you took the office unit that or they weren't using and converted it back into a unit. So it went from a 31 to 32, and it fit all the metrics, and it showed we can give our investors conservatively. Jonathan's background was he got a master's in finance at Rutgers and practiced for 20 years in New York City as a CPA, and he oversaw 100 CPAs in New York City. Over that period of time, watching returns, he started buying a lot of single family and duplex, and eventually figured out multi's better. And so by 2017 to 18, he transitioned full time, moved to Dallas, and he just got a deal. So the point is, I looked at it, and I had all kinds of other scrutinous people look at it, and I had to explain to investors that we don't really have to renovate properties. I've been in these units. They've been renovated. It was renovated in 2022 and 2023. We were going to do some light renovation on one of the roofs, but the lender said we had to fix that before we closed, so they've paid for it. So there's not a lot to do. What can be done, I would explain that, but you could upgrade the units. They've been the same, but it's a block from the courthouse, and it's wrapped around all these lawyer offices. And I can see, and it's across from a big church and a school. And I used to be in the ministry, so I would probably live there for a while I was looking for a house and I could walk to work. And, I went and did the tour of talking to all the different businesses, the art galleries and the restaurants and all the shops around it. And I said, wow. So I'd explain to investors, this hits all your metrics without doing renovations, without doing all of that. And so since he was in it and he beckoned me into it, that's how I got involved. And so we have people that have done it. We just learned that if it's going to hit those metrics, if it's going to be a win for the investors, and if we get a break somewhere, for example, if somebody moves out and we decide, okay, let's put a little in there, upgrade a little bit, stainless steel appliances, refresh the pulls and nicer drawer closes, rent it out. There's going to be some lawyer moving to town who'll rent it for a year. Let's start going after that market. You can, but at any rate, he did, would be my point. And I guess I learned from that to say, apparently you can. Obviously, you'd look at that. Are you sure? His only extra income is offer U-Haul money. Those that want valet trash, we might put another vending machine or something in there. You might offer preferred parking, but it's a small thing. It's already got covered parking for most of it.
Mm-hmm.
So we really had to rack our brains, but with his experience, he did it. So I would just say that. And I'm horrible at long answers to short questions, so I'm done.
No, I think it's interesting because, right, we've been trained that we have to look for these big levers, right? Like $300 under market value, or, a huge renovation project to go out and do this. And so, like, if you come across something like that, like, how do you feel, right? Like, it's something that I've come across in my underwriting experience of like, well, even if we don't move the needle a ton, this is actually, generating 50 or, 55% of the money for our investors from cash flow, not even from the sale. So like, it's just a really heavy cash flow property that is performing extremely well. So we go in and we maintain performance and milk it for everything it's worth? Is this something that, you hold for 10 years or 5 years? Like, it looks better on a longer hold because it just performs.
Yep.
So yeah, it's definitely interesting.
Yeah, well, that's
I put in the chat, if we bought it at less than 64.5 per door,
Mm-hmm.
and others had closed in last year at 100 grand per door, similar ugly property. Well, they weren't ugly, but they were, modest C properties. To somebody who paid 129 grand a door for one of them. I guess they had a really good broker. It worked. I mean, if somebody wanted out, then there's that.
Yeah. No, thank you for the feedback. I greatly appreciate it. Well, I had one other thing, but it's going to take more than 4 minutes. So let's just move to questions, comments, concerns. Is there anything weighing on you guys that we should talk about? Like I said, we only have about 3 or 4 minutes left. So
what do you think
If
about
nobody asks
ground up
questions,
development starting now?
whoop, I'm so sorry. Let's do Robert first and then David.
Oh, I was just going to say, what about ground up development now, starting now, finishing 2 or 3 years? The lease up would finish 2 or 3 years. It'd be right in that supply cliff area,
Yeah.
and you'd have less competition that's newer and such like that. You'd have a competitive advantage. What do you think about that idea?
Yeah. So to answer your question, and I'm going to take a page out of David on this one and make a really short question into a long answer. We have zero experience for ground up new builds. And even we have a little bit of experience of a lease up play, right? Like, because it's very different than a value add play,
Oh, yeah.
because you're not seeking agency debt with 90 over 90. It's totally different in how you process those deals. And usually you get some kind of bridge loan so that you can go into a agency debt. So we've done 2 lease up plays. Our company has. We have been talking to a couple of people about ground up construction, to be honest, because how do I say this politically correct? The swings are bigger, right? Like, you can make significantly more money on new construction than you can on like traditional value add. But you can also make significantly less if it's done incorrectly. And so part of the reason that we jumped into this is we actually got introduced to a family office that specifically is looking for ground up new developments. That's all they want to do. And so that's the only reason that we're even remotely entertaining the idea, is because like if I have funding, I'm going to go and try and find something that meets their requirements and then get with their project manager to help, train us on how to process that deal and help them the most. And so long story short, I like the idea and we've been entertaining it, but we have zero experience and zero ins into the industry. But I went to NMHC, was it last week? No, 2 weeks ago? I don't remember. Like last week or 2 weeks ago, and I met with a bunch of brokers and they said, hey, I have some ground up new construction, because I told them I have a family office that is looking to fund. And that opened up a ton of doors. So it was just getting them over to that family office and being like, take your pick, man. One of them, all of them, I don't care. If you like it, I'll help try and, facilitate whatever I can with them. So, but yeah, it is a strategy to kind of beat the cliff that's coming in that no deliveries basically in the next couple of years coming. So did that answer your question?
Those are two completely different disciplines, and if you're not skilled in that area of doing ground up construction, that's a whole different thing than value add.
Yep. No, 100%. And that's why like I'm honest with them right up front. Like I have no experience, we have no experience, but we are willing to, learn through the process and help you guys. So
yeah.
But yeah, that's a great one. All right, David, and then Mitchell, did you have something?
Kind of, yeah.
Okay, we'll go David and then to you.
Okay.
I would just echo what you said. So if I had a sponsor that really is interested in that, and when I say a sponsor, I mean somebody who will not only sign on a loan, but they have a lot of experience at it, and they can co-GP and lead it, make sure it happens. I've seen people hit home runs with it. I've seen people die, horrible deaths with it, and I'm not wildly interested in it. But while I was down in Dallas at one of the mastermind events with Jonathan, he had us go and look at a place which was pre-leased, a 300 plus unit in a superb location right next to gorgeous, large, expensive homes, and where shopping was across the street and so on. He says, the guy's asking, are you guys willing to raise capital on this? It's ground up, but you could see it. It was maybe a year away from completion, pre-leased. People were ready to move in as they completed it. So that one he was considering that. He did have us actually go and look at a site where somebody was going to do. So what I'm saying is even conservative guys look at that. It would sure scare me. I want to make sure I have people ready and signing their blood on the line for that. So I'm done. Thanks.
Yeah, it's totally different than anything that we've experienced so far. So brand new territory for sure.
Yeah.
Just something I was going to mention, or not to put a shameless plug, but Eddie Austin, he liquidated his assets and revenue. He was revenuing about 100 million annually, but he's built his own construction outfits, and now he's developing in Tennessee. So maybe you guys could bridge together. That's very cool. Good connections, sounds like, with the home office and different things. So
yeah, no, for sure. If you want to send me an email and get us connected, like I said, I know nothing. I just this is what they said they want, and I'm like, I'll go find it. Like I have no problem doing that. So
he's got live, like you guys do on Mondays. Eddie's got Wednesdays at 3:30 Mountain, 4:30 Central, 5:30 Eastern.
Called Game Changer.
2:30 Pacific time, Game Changer. So I'll send you an email and send you a link and maybe hop on this Wednesday.
Cool. Yeah, I'd love to look at it.
Okay.
Yeah, that's one one of the things that we've been, I guess, learning this past year is the scary challenge and the beauty of diversifying our portfolio. We were very much like we are value add, take a class C, make it a C plus, make it a B. Like we had our formula, and the landscape is changing. And what can we do to diversify our portfolio, make sure we're meeting the needs of our investors, meeting the needs of the market? And so, we are looking at one that's potentially non a value add, because it doesn't really need it. And so it's like Tyler was saying, kind of like a hold period, and try and just make money and for our investors and, keep the property up and stuff like that. We've looked at new build, new construction. So it's just where is the demand? What is the need? And, what can we do on our end to facilitate those deals and facilitate our returns for our investors? So yeah, it's been a formative year for us, and we're very excited to see kind of what the next year brings. So
Awesome.
Very awesome. Yeah.
Well, hey guys, I appreciate you joining us today. That brings us to the end. So we will see you guys next week, and have a wonderful weekend. And if you're going to Best Ever in Salt Lake, let us know, because that's next week, and we will be there. So
yep, the whole team will be there. So.
Yep. If you guys want to talk to us in person, let us know. We'll see you there. Bye.